Welcome to the first episode of Mastering the Basic RSI. If you're interested in trading or technical analysis, you've probably heard of the Relative Strength Index, or RSI. But what exactly is it, and how can it help you make better trading decisions? In today's video, we're going to introduce you to RSI, explain how it works, and show you why it's a must-have tool for many traders. By the end of this video, you'll have a clear understanding of what RSI is, how it works, and why it's so popular among traders in the forex, stock, and crypto markets. So, let's dive in. RSI, or the Relative Strength Index, is a popular technical indicator that helps traders measure the strength of a price movement. Developed by J. Wells Wilder in 1978, RSI is a momentum oscillator, meaning it helps traders understand whether an asset is overbought, oversold, or in a neutral zone. The RSI value ranges from 0 to 100. Traders typically use this indicator to identify potential reversal points in the market. The idea behind it is simple. When an asset is overbought, the price might be due for a pullback. And when it's oversold, it could be ready for a rise. How to read RSI? Let's take a quick look at how you can read RSI on a chart. RSI is typically shown as a line on a scale of 0 to 100, and here's how to interpret it. 1. RSI above 70, overbought. When the RSI is above 70, it suggests that the asset is overbought. In this situation, the price could reverse or correct downwards. 2. RSI below 30, oversold. When the RSI is below 30, it suggests that the asset is oversold. This could signal that the price might rise or reverse direction. 3. RSI between 30 and 70, neutral zone. When the RSI is between 30 and 70, it indicates a neutral market condition. In this case, the market is neither overbought nor oversold. In this situation, you can look for smaller movements and trend changes in the RSI, such as divergences, which we will discuss in later sections. 3 reasons why RSI is important for traders. 1. Helps spot overbought and oversold conditions. It shows whether an asset is overbought, too expensive, or oversold, too cheap, helping traders make better decisions about when to enter or exit trades. 2. Trend reversals. By identifying overbought or oversold conditions, traders can anticipate potential trend reversals, allowing them to take profits or enter trades when they believe the price will change direction. 3. Simple and easy to use. RSI is easy to understand, even for beginners. Its straightforward nature makes it an excellent tool for those just starting with technical analysis. To sum up, RSI is a valuable tool for traders to spot overbought and oversold conditions, helping make better trading decisions. In the next video, we'll dive deeper into how to calculate RSI and apply it to real trading strategies. But for now, make sure to subscribe and hit the notification bell so you don't miss out on any future videos in this series. Thanks for watching, and good luck with your trading.